Hi everyone, welcome back to JP Macro Model. I'm Jack Profit, and today we're talking about the big picture, the US stock market. Yes, it just hit another all-time high. Valuations have now surpassed even the dot-com bubble of 2000, so the question is no longer will it crash? The real question is, what's keeping this bubble from bursting, and who will be fast enough to get out when it finally does? In this video, we'll explore 5 key parts. What history tells us about past valuation peaks? 1929, 1965, 1999. How current market valuations have gone off the charts. Why this bubble hasn't burst yet. The hidden liquidity forces. The key risks and warning signs to watch. What smart traders and investors can actually do right now. So grab your coffee. Let's dive in. Part 1. Lessons from History. The 3 Great Peaks. 1.1. The 1929 Crash. The Roaring Twenties Gone Wrong. The 1920s were a time of prosperity and euphoria, a new era of growth, technology, and credit. Stock prices soared as everyone believed the boom would last forever. But by late 1929, valuations were sky-high relative to earnings. Margin debt was rampant, liquidity tightened, and confidence snapped. What followed was the Great Depression, wiping out 90% of market value. Lesson: when valuation meets leverage and confidence breaks, the fall is brutal. 1.2. 1965. The Lost Decade. Before stagflation, the mid-1960s looked great on the surface. Growth, low unemployment, and optimism. But stocks were priced for perfection. When inflation and interest rates spiked in the 1970s, investors realized their valuations were unsustainable. The market didn't collapse overnight. It simply went nowhere for 10 years. In real terms, investors lost almost half their purchasing power. Lesson: not every bubble ends with a crash. Some just rot slowly. 1.3. 1999. The dot-com mania. Then came the dot-com era. Tech was the future, and everyone believed this time it's different. P/E ratios soared above 100 for many tech names. The Nasdaq tripled in just a few years. When the bubble burst, the Nasdaq lost over 75% of its value. Investors learned again that innovation does not justify infinite valuations. Lesson: euphoria always rhymes. Different decades, same psychology. 1.4. Summary. History never repeats, but it rhymes. Every major peak shared 3 elements: extreme valuations, excess liquidity, or easy credit, a belief that this time it's different, and each time, when liquidity shrank and faith was tested, the market paid the price. Part 2. 2025. Valuations have never been this high. So, where are we now? Let's look at the numbers. 2.1. Shiller-Cape ratio, cyclically adjusted PE. The Cape ratio averages earnings over the past 10 years and adjusts for inflation. The historic average is about 16 to 17. Today, it's hovering around 39 to 40, the highest in U.S. history. That's above 1929 and above the dot-com bubble of 2000. Source: Robert Shiller, Y-Charts, currentmarketvaluation.com. 2.2 Buffett Indicator, market cap to GDP. This indicator measures the total value of the U.S. stock market versus the entire economy. At the dot-com peak, it was 150%. Today, it's around 217%. Warren Buffett once said this is probably the best single measure of where valuations stand at any given moment. So by that standard, we are in uncharted territory. 2.3 other metrics confirm the same story. Price-to-sales ratios at record highs. EV/EBITDA and P/B, multiples well above historic averages. Equity risk premium, the spread between stocks and bonds, has shrunk to near zero. When you're paid the same for holding risky stocks as for safe bonds, that's a sign of complacency. 2.4. Why it's so dangerous. High valuations don't predict when a crash will happen, but they do predict low returns and higher risk. Historically, when CAPE is around 40, the next 10-year real return averages 0% to 2% per year. That's the trade-off investors are making today. 2.5 Summary: the most expensive market ever. So yes, by every classic measure, the U.S. stock market is more expensive than it has ever been. That doesn't mean it will crash tomorrow, but it means the margin for error is gone. Part 3. Why hasn't the bubble burst yet? This is the heart of the video. If the numbers are so crazy, why is the market still climbing? There are three major reasons: liquidity, belief, and structure. 3.1. Liquidity, the hidden fuel. Even though the Fed has raised rates, real interest rates after inflation are still low. Meanwhile, the U.S. Treasury and the Fed continue to inject liquidity indirectly through the repo and reverse repo systems. Global capital is also flowing into the U.S., because where else can you go? Europe's growth is weak. China's economy is struggling. Bonds are boring, so money keeps flowing into U.S. equities by default. This is why we say the bubble is liquidity-driven. 3.2 Belief. The AI narrative and the new era syndrome. Every bubble needs a story. In 1929, it was the automobile and radio. In 1999, it was the internet. Today, it's artificial intelligence. Investors believe AI will revolutionize everything, and they might be right. But they're pricing it as if it already has. The so-called Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Meta, Tesla, Alphabet, now make up almost 35% of the S&P 500's market cap. That's an unprecedented concentration of wealth in a handful of names. The story is so compelling that even investors who don't believe still feel forced to buy, because everyone else is. That's FOMO at a global scale. 3.3 Structure. The ETF and passive revolution. Here's something most people don't realize. Over 60% of U.S. equity investing is now passive, through index funds and ETFs. That means billions flow in automatically every month, no matter the price. It's a constant bid that keeps markets afloat even when valuations are insane. Add in corporate buybacks, over $1 trillion this year alone, and you get a self-reinforcing loop. Money flows in, prices rise, more flows follow, prices rise again. That's momentum on autopilot. 3.4 Summary: liquidity, belief, and structure. In short, the bubble hasn't burst because there's still plenty of liquidity. There's a powerful story people want to believe, and the structure of the market automatically feeds itself. But like all cycles, these supports don't last forever. Part 4. The risks and warning signs. Let's be clear. High valuations don't kill a bull market by themselves. It's the catalyst that turns sentiment from greed to fear. So what could that catalyst be? 4.1. Rising real rates, or inflation shock. If inflation spikes again, and the Fed is forced to tighten further, real interest rates would rise. That means the discount rate used to value future earnings goes up, and valuations come down. Tech stocks are the most sensitive to this change. 4.2 Earnings. Disappointment markets are priced for perfection. If earnings growth slows, especially for AI leaders like Nvidia or Microsoft, we could see a major repricing. Remember, at 40 times earnings, you need spectacular growth just to stay flat. 4.3 Liquidity withdrawal. If the Fed or Treasury reduce liquidity through QT or fiscal tightening, the market loses its fuel. Without fresh money, momentum turns to friction, and the ETF flows could reverse. 4.4 Geopolitical or credit event war, debt default, banking crisis, you name it. At these valuations, even a small shock can trigger a large correction. IMF recently warned that U.S. stock valuations pose a disorderly correction risk. 4.5 Sentiment shift. When FOMO turns to FUD. When everyone is all in, there's no one left to buy. The moment the crowd decides to take profits, liquidity evaporates. We've seen this movie before. 2000, 2008, 2020. 4.6 possible scenarios. Let's simplify it into 3 scenarios. Bear shock, 30 to 50% drop. A liquidity or confidence shock triggers a steep sell-off within months. Sideways drag, 0 to 10% returns. Valuations stay high but returns flatten for years like 1965 to 1980. Soft landing. Growth catches up with valuations. The best case, but historically rare. Part 5. Who will keep up and who won't. 5.1 Who might survive or win investors with discipline and risk management. Those who hold quality companies with strong cash flows and low debt. Traders who follow a clear system, like my JP macro model, and adapt to volatility instead of fighting it. People who diversify and avoid emotional trading. 5.2 Who will lose investors who chase momentum without understanding valuation. Retail traders who buy the top because it can only go up. Those who ignore risk and forget to manage position size. At these levels, the market punishes overconfidence more than ever. 5.3 Strategies for this environment. Let's be practical. Don't go all in. Use cash wisely. Deploy slowly if you're DCAing. Focus on quality, strong balance sheets, cash flows, and pricing power. Trade volatility smartly. If you're a trader, this is a great time to capture swings, but not to over-leverage. Respect risk/reward. Even if you're winning, protect your capital. You'll need it when the cycle turns. Part 6. The psychology behind the bubble markets are ultimately a mirror of human emotion. Prices move on math, but trends are powered by stories. If we want to survive at the top of the mountain, we need to understand the mindset that built the mountain. 6.1. The this time is different. Trap. Every major cycle comes with a brilliant narrative. In 1929, it was mass production and credit. In 1999, it was the internet. Today, it's AI. These narratives are not lies. They're true, just not true enough to justify any price. The trap. When a real innovation arrives, investors project infinite growth and forget finite cash flows. The fix, separate technology adoption, which can be exponential, from business profitability, which is constrained by competition, costs, and cycles. 6.2. Herding and social proof. When everyone around you is getting rich, the safest feeling in the world is to join the crowd. ETFs, passive flows, and social media amplify herding. The more concentrated the wealth, think a handful of mega-cap names, the stronger the feedback loop, until it isn't. 6.3. FOMO, euphoria, complacency. FOMO says, I'll miss the train. Euphoria says there is no crash. Complacency says, even if it dips, it will bounce. When these three line up, risk controls usually disappear. 6.4. Loss aversion on the way down. On the downside, humans freeze. We anchor to the price we paid. We wait to get back to break even. Lesson: define exits before you enter. The market doesn't know your entry and doesn't care about your feelings. Part 7. A practical playbook, trader plus investor. This is where we turn insight into action. Think of it as your checklist for the next 6 to 12 months. 7.1. Portfolio construction, investors. Don't go all in at record valuations. Phase entries, DCA by time and by price. Barbell approach. Side A, quality compounders, strong cash flow, low leverage, pricing power. Side B, cash/T-bills or short duration bonds for optionality. Position sizing, cap single name exposure. Avoid letting one winner become your whole portfolio by accident. Rebalance rules. Pre-commit to thresholds, AEG. If a name greater than 12 to 15% of portfolio, trim back to target. Expectations. With CAPE approximately 40 territory, anchor to subpar long-term returns, let upside surprise you, not the other way around. 7.2 Risk Management, Traders and Swing. Define R before entry. If you risk $100 per trade, codify it. 1 to 2 RR as default, your JP macro model style. But only if the setup quality is there. Trade fewer, better setups. At extremes, volatility can spike. Protect your mental capital. Time windows, stick to your best sessions, e.g. your 9:50 to 10:50 windows, and avoid revenge trading outside plan. One trade at a time. Avoid stacking correlated risk during macro events, CPI, FOMC, earnings of megacaps. Have a kill switch. If you violate rules twice in a day, stop. Capital protection greater than hero trades. 7.3 Hedging Ideas, Advanced. Tactical cash is the simplest hedge. Index puts slash collars during event risk earnings season for top names, CPI Fed. Diversifiers, careful with gold, crypto, they can decorrelate until they don't. Use sizing, not faith. 7.4 Earnings and Liquidity Calendar, mark down the liquidity weeks. Heavy treasury issuance, balance sheet shifts, month-quarter ends, track mega-cap earnings as systemic events. A miss from one AI leader can drag indices. 7.5 Behavioral Guardrails. Pre-mortem. If I lose 20% from here, what did I do wrong? Fix those behaviors now. Post-mortem. Quick, honest journaling. What was the plan? Did I follow it? What did I learn? Public accountability. Share rules in your community. It raises discipline. Part 8. Signals to watch. Dashboard. Here's a simple dashboard you can screenshot or put on a whiteboard. You don't need 50 indicators, you need 5 that bite. Real yields. 10-year tips. Rising real yields compress PE. Watch for sharp moves up. Liquidity proxies. Fed/Treasury, repo/RRP balances. Net withdrawal often foreshadows risk-off. Earnings, breadth. Are gains driven by 5 to 7 names, or is participation widening? Narrow leadership equals fragile. Credit spreads, IG/HY. Spreads widening equals stress building behind the scenes. Volatility regime, VIX/VVIX. A low, complacent VIX that suddenly awakens is classic turning point behavior. Tripwire examples. If real yields plus 50 to 100 basis points in weeks, reduce gross exposure. If credit spreads jump and VIX breaks out, tighten risk, shorten timeframes. If breadth deteriorates while index makes new highs, avoid chasing breakouts. Part 9. 3 scenarios and what I'd do. Scenario A, sharp drawdown, minus 30% to minus 50%. Catalysts, liquidity withdrawal, inflation shock, earnings miss from AI leaders, credit event. Investor, deploy cash in tranches, never all at once. Prioritize quality at reasonable prices, harvest tax losses if relevant. Trader, trade the trend, not the bottom. Volatility equals opportunity but reduce size. Scenario B, sideways, choppy, low. Real returns, 1 to 3 years. Investor, dividends plus selective value plus patient DCA. Sell covered calls on large positions if suitable. Trader, range strategies, mean reversion, honor stops. Don't force trend trades in a range. Scenario C, soft landing, earnings. Catch up. Investor, keep a core in quality plus let winners run, rebalance gently. Trader, buy the dip within trend but respect news risk, no complacency. Conclusion. Who will keep up? Let's bring it home. We're living through one of the most extraordinary valuation moments in market history. By most measures, U.S. stocks are more expensive than 1929 and 2000. That does not guarantee an immediate crash, but it does guarantee a smaller margin for error. What keeps the bubble levitating? Liquidity, domestic and global. A powerful AI narrative that investors want to believe. Market structure, passive flows, buybacks, and momentum. What will end it? rising real rates, earnings disappointment, liquidity withdrawal, credit chalk, geopolitical shock, or simply a change in belief? Who will keep up? Those who respect risk, size positions intelligently, and stick to rules. Those who can trade volatility without letting volatility trade them. Those who accept that even great stories don't justify any price. If you're an investor, protect your optionality. If you're a trader, protect your edge. In both cases, protect your capital, because capital is the ticket that keeps you in the game when opportunity finally screams. If you found this helpful, like, subscribe, and comment. Do you think the market corrects within 12 months, or do valuations stretch for another year? I'll read every comment and may do a part 2 with your questions and sector deep dives. I'm Jack Profit. This is JP Macro Model. See you in the next video.